Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
Okay, so what we're going to do is talk about the future of real estate, where we see this thing going. We got a bunch of charts that are historical that go all the way back to before the 1980s. We're going to show you some trends, and we're going to talk about what's going on right now. A lot of stuff has happened just in the last week. But we're going to try to paint a picture where we think all this is headed. Okay?
Okay.
All right. So we've got a bunch of charts. So you have to be patient with us. We will be talking about some macro stuff and stuff that's happening right now that's more potentially macro that could lead to other things.
Okay.
Okay, here's the first. We'll start with the first chart. Okay, this is median asking rent. It goes back to 1988. This chart, if you looked at this chart and I said, what is this? You would say, this has got to be a bubble. This has got to burst.
No.
No, probably not, right?
No, I don't think so. I mean, is there room for it to taper and then take off again? Yes, but I don't see it bursting, because bursting would imply that it's going to go down significantly, and there's no reason why that would happen. We don't have an excess amount of housing. We're not building enough homes for the people that either are getting to adulthood and starting new households or immigration or anything else. So no, there's no reason to believe that we're going to see a substantial decrease in rental homes as far as the rent values.
Okay, so let's talk about this from a today perspective and then the future perspective. Let's say you own 10 rentals.
That would be nice.
And you're collecting $2,000 a month from each one.
I would be delighted.
You get $20,000 a month. Now, some of that money goes to maybe pay a property manager, but then you pay some taxes and other stuff. But the rest is you live off it. It goes in the bank. Maybe you save some of it. You put it in an account to do repairs on, rehab a house, maybe after a tenant moves out, right? Okay. But 5 years ago, you were only getting $1,400 a house.
Okay.
Now you're getting $2,000 a house. And actually, you think you're trying to figure out when you'll be getting $2,500 a house or $3,000 a house. And what you're figuring out is you don't really know, but you do know is prices go up, you're just going to raise rents so you can afford your cost of living.
Right.
So you're going to pass on your inflationary cost of everything to your tenant. So we've had people come on the channel and say, but Todd, people are going to profit take. No, this is not the stock market, guys. Okay? You do not get, home prices don't go up by a 4x in a month where you could sell and then wait 2 months and they drop back down and then buy them again, right?
Well, so rentals are kind of a different thing than the stock market, right? Because people have rentals for appreciation, yes, but what they have rentals primarily for is income.
Okay.
So if you're selling a rental, then you're generally either taking the money to invest it in some other way or buying another rental or maybe buying more than one rental. So that's a little bit different. It's different than the stock market, you're right. And people who have rentals, like I said, they're interested in that income.
And you probably have all the rentals listed on a spreadsheet and what they're worth. So you can see your net worth. You don't need to sell it to realize the net worth, because what do you have to give the government when you sell your rental house?
We have to give them money, and so generally people who have rental houses are not fond of giving the government money. So a lot of times what they'll do is they'll do what's called a 1031 exchange, where they will sell one rental property, use the proceeds from that rental property sale, and maybe buy more than one rental property so that they can leverage that into multiple properties and keep increasing their rental property holdings.
Okay. Landlords, people who own houses, are not selling for a lot of reasons, especially inflation. Any fear of inflation, people aren't going to sell. This is one of the reasons why we've gone from 16% of all houses free and clear 20 years ago to 42% today. Because people have just like, I'm keeping this thing as an inflation hedge. And maybe you sell them and buy, a house you've always wanted on the beach or something, right?
Right.
Or the house in, who knows, right? Luxury neighborhood.
Right. So, remember a lot of rental properties are owned by people who are not necessarily that young. And so a lot of people use it kind of part of their estate planning. So they're thinking that maybe they've got 3 kids. Maybe they're looking to have 3 rental houses, so each child inherits one of the rental houses. Maybe they've got some grandkids. Maybe they want the grandkids to inherit some of the rentals. So it's an interesting estate planning tool. I've seen that a lot with people.
Okay, now you're probably saying, but it's just so expensive right now to buy a house, and I'm going to rent because buying a house is too expensive. Well, remember, okay, think about the chart and how rents were going up all the time. Wanda, what's the first thing that happens for the next 30 years if you buy a house?
Well, if you buy a house, the first thing that happens is most people have fixed rate mortgages. So that means that the money that you spend for your housing all of a sudden becomes fixed or relatively fixed. I mean, I do acknowledge that property taxes do go up, and I do acknowledge that insurance does go up, but they go up nominally compared to what rents go up, right? So that's a big consideration. So if you want to have better control of your housing costs, one way to do it is to purchase a home with a fixed rate mortgage, because then your mortgage will remain the same payment every month until you pay it off.
Unless interest rates drop, and then what do?
If interest rates drop, you have the opportunity to refinance.
Oh.
And if you refinance, that payment drops. Now, it drops for a couple of reasons. First of all, because you have a lower interest rate. And second of all, because the loan gets re-amortized for another 30 years.
Okay, I'm gonna extreme scenario for an example. You buy a house, you get a 7.5% loan. Your plan is you're going to pay it off, or not. You're not going to pay it off. You're going to, refi it.
Okay.
When interest rates drop. But we just have this nasty inflation thing. Government keeps spending money. There's all this money being printed, and we just have 10, 15% inflation every year in the U.S. So borrowing costs go through the roof, and now a mortgage is 15%. So you now have a 7.5% mortgage. Person buying a new house, right, or buying a mortgage has 15%. But remember, everything's going up. So you're getting wage increases and everything. Now your 7.5 mortgage doesn't look that bad.
Not at all, because you're paying that mortgage off with basically worthless dollars, because you just said that inflation's out of control. So it means that your wages have gone up too. So that mortgage payment, whatever that is a much lower percentage of your income than it was when you first took out the mortgage.
Okay. So that's one. Now, obviously, that what we're pointing out is something called interest rate risk. It's on the bank, because if interest rates go up for a long period of time, the bank is stuck. That's like all these 3% loans that the mortgage-backed securities are owned, that they're sitting on. It's a problem for them because the cost of borrowing money is even more. So if they want to loan out money, they got to sell these 3% notes to loan you money at a higher rate, right? So that's not a really good deal for them, because they lose money on it. They can't sell the 3% note for face value. They have to sell it for a lot less. Okay, now, but you're saying, but the price to rent ratio with interest rates right now, they're way too high. Well, let's look at this chart. This is the price to rent for all the English-speaking countries and Japan. They threw Japan in there. And Sweden's in there, so maybe they're not all English-speaking. But these are like the most developed nations, right? Most comparable to the U.S. New Zealand, 280%. Canada, 240. Sweden, about 180. Australia, 160. UK, 120. Germany is even ahead of the U.S. And the U.S. at about 40. So if your rent payment in New Zealand is $2,000, then it is 2.8 times more expensive. So it'd be $7,600 to buy a house in New Zealand for the same amount of money you could rent for $2,000. So all of a sudden, that $2,800 versus $2,000 in the U.S. isn't that big of a deal, right? It seems a lot better than $7,600.
Right. So when you compare the cost to purchase a home in the U.S. versus the cost to purchase a home in these other countries, the U.S. is a smoking deal, as you would say, Todd. It's a great deal. In New Zealand, it's very unaffordable. In Canada, it's unaffordable. In lots of places, it's unaffordable. I know people talk a lot about how unaffordable it is in the U.S. Honestly, it's actually really affordable, because it's only a third of people that rent. That means that 2/3 own. And that's not the case in a lot of countries. Now, I recognize that homeownership is higher in some countries than in the US. I don't dispute that. But what we're talking about is countries that are on par with the US with economic development and with other opportunities.
Croatia has one of the highest in the nation, but homes
In
are
the
really
world, yes.
cheap, and they gave them away. When communism ended, they just, if you were in the house, you got titled deeded in your name.
Right. So a lot of former communist countries have higher home ownership because of that. However, when you compare their homes with our homes, I think you'd rather live in our homes. When you compare their economic situation with our economic situation, I think you'd rather live here. Because if you wouldn't, we have a great policy in the US. It's called being able to leave anytime you want.
Yeah.
So feel free. We're not like other countries that make it difficult to leave. We have the doors open. You can leave anytime. So clearly, if you're still here, you must think that the US is a pretty good place to live.
Okay, here's the next chart. Now, you're probably saying, but what if I just want to wait for home prices to drop so I can, run out there and I'll buy a house when home prices fall. Well, this is the last decade of home prices. Mm-hmm. And what this chart shows is a starter home. Now, this does not mean new construction. This means a home that if you put all the homes from the most expensive to least expensive, it's from the 5% to the bottom to the 35% to the bottom, okay? So basically, it's the bottom third of homes, except for the bottom 5%. They throw those out. This is the median price for a starter home in the US as of June 23 is $243. This chart, and what's cool is you can see the seasonality, how the home prices drop a little each fall. This is a really good chart for that, actually, kind of wavy going up, scallopy. And it's more pronounced. It really didn't happen in 2021, but you could see it happen in 2022. But even now, home prices are going up again. So if you're saying, I just want to wait for, interest rates to come down. Well, what if it's 3 years? And now the starter home is $280, and you could have bought it today at $243, and then the extra amount you made in your payment, who cares? You just made $40,000 in equity. And I think that's the thing that I'm not saying it's a good time to buy. So before you put that in the comments, we're saying all we're pointing out is what happens if you delay purchasing an asset that's literally tied to inflation during inflation times when we have inflation, which is pretty much all time since World War II ended.
Well, so there you have it, the scallopy line that tells you the whole story.
If you were knowing what you know, if you had just came here from Romania, but you did come from Romania, but a long time ago, and you did get to the point where you could swing it would be tight. Okay. Would you buy a house or would you wait?
Well, I would buy a house, and that's what my parents did as soon as they were able.
Okay, now let's talk about this too. This is my personal opinion. Immigrants are buying houses. Do you know why? Why is an immigrant coming here and buying a house?
Well, because
even though it's 40% of their income to make the payment.
Okay, so immigrants are very likely to buy a house for a lot of reasons. First of all, it provides stability. It anchors them. They've just left everything that they've known, and this is a way to put down roots. So that's a psychological thing. The other reason is that they want to. A lot of immigrants actually have a pretty good sense of money, and so they understand that this is a way to fix their housing cost. They also understand inflation because a lot of immigrants come from places that experienced out of control inflation. So they also understand that housing over time tends to go up, and this is a way for them to purchase a home today and then pay it on it over time as their income increases due to either earning more money based on merit or based on a combination of merit and inflation. So lots of reasons why immigrants would purchase a home.
Okay. They're also not whiny. Oh, I need to buy, I go to Starbucks and I got to spend money on all these other things and yada, yada, yada. They just go all in.
Well, immigrants tend to kind of, put their nose to the grindstone and work because they they understand that they have a unique opportunity that a lot of their fellow countrymen will never have, and they want to do the best that they can for themselves and their families. Immigrants have a strong sense of wanting to have a better life for their children. Not that everybody doesn't, everybody does, but I think that they have a much greater commitment because they've worked so hard to get here and they're willing to put in the work. It's just a different mindset. I mean, if you look at immigrant populations, that first generation tends to be super hardworking and super high achieving. And as you get farther and farther from that first generation, you see a lot of times that work ethic kind of decline.
So are you saying that because you are first, like you came over, not speaking a word of English?
That's right.
And now no one would know you didn't ever not speak it your whole life.
Well, I think that I still have an accent, but I think you have to listen for it.
You do have an accent. Okay, now we're showing this next chart. This is short-term rentals. And you're probably saying, yeah, but the short-term rentals, when they flood the market. No, they're not flooding the market. Actually, every year, it appears there will be more and more short-term rentals. This is why. Let's go to 2021. The occupancy rate of a short-term rental was 60%. So 60% of the month it was occupied and 40% of it was vacant. But the average daily rate that they got was $260. Now remember, an average rent in the US is only $2,000. So you only need to have the thing rented like 8 nights. But they're having these things rented like 18 nights. So they're actually getting probably $5,600 a month from their short-term rental instead of $2,000 a month. So Juana, I'm going to make you do math in public, okay? You've got a 60% occupancy rate. You're at $260 a night, okay? And this number appears to be growing, the change in rate, because you could forecast by the end of this year to be 290. Some of that's inflationary, and rents are $2,000. Okay, here's the math in public. You own this house, and you've got to figure out which to do. Someone says you can have $2,000 a month or $5,600 a month. Which of those two numbers is bigger?
$5,600 is bigger.
Did you see how fast she did that math? She was like, I gave her like all those numbers, and then bam, she was like super fast.
Right. So look, I acknowledge that $5,600 is not all take home. I acknowledge that short-term rental people have costs that regular landlords do not. But at the end of the day, clearly it's still more profitable to do a short-term rental. That doesn't work for all houses. It doesn't work in all markets. And it is seasonal, right? Depending on where you live, it is seasonal, unless you're someplace like, Miami or someplace like that that's basically year-round. In a lot of places, so if you're maybe in a in a ski area, then obviously that's seasonal for the winter. Depending on the beach area, maybe if you're out of Cape Cod or something like that, then that's for the summer. But there are lots of places where this is basically year round. So some place maybe like New York would be year round, like Vegas, that would be year round. So it just depends on where you are.
Okay, the next chart. Now this is the amount of real estate homes in Nevada that are upside down. They have negative equity. As you could see, back in 2010, it was 70%, and then it dropped. Well, at the end of 2022, we had 1.1% of all homes had a higher loan than what they were worth. The foreclosure, the risk is literally zero. It's the lowest it's ever been. This idea that all the foreclosures are going to happen because people are getting 7.5% loans. My God, no one can afford that. There's nothing further from the truth. People getting loans today are putting 20+% down. So that's why, 2022, what were rates in most of 2022? 6-7%, right? They peaked.
And then remember, it doesn't really matter what interest rate people are getting, because if they couldn't afford the loan, the banks wouldn't lend them the money, right? This is pretty straightforward. That's what's called qualifying for a loan. You don't just show up and go, hey, give me some money, and they go, yeah, here's some money. It doesn't work like that. You have to qualify for the loan. And the qualification guidelines are pretty stringent. So, people who are getting these loans can pay for them. Otherwise, they wouldn't be getting them.
If you bought a house at the beginning of 2023 in Las Vegas, is zero down, VA loan, you just bought it, right? 7.5% rate, who cares, but you're making the payment every month. That house today on a 2,000 square foot home, whatever you paid for it, based on if you bought it at the median price per square foot at the time, January 1st, is worth $26,000 more today. Already this year, you made 26 grand because that's just on the appreciation, because the price per square foot is $13 a square foot. You've got a 2,000 square foot house, you made 26 grand.
Right. But remember, that's funny money. That money only matters when you sell. Look, the price, the value of the home only matters twice, when you buy it and when you sell it. And in reality, it only matters once, when you sell it.
What I'm pointing out here, and the reason I'm using Nevada data, first of all, we have it. We have access to it because it comes from the Realtor Association. The second is, with the highest foreclosure rate in the nation in Nevada. So if we're only 1.1% and this gives us the highest rate, all the other states are way better than us. So there's almost no risk, no matter where you are in the country, of massive amounts of foreclosure. Matter of fact, somebody posted in a Facebook group, because they track all the foreclosures in California. So they took the 10 largest population counties and they did a foreclosure update for each county for the week. LA County had 3 foreclosures in a week. Orange County had 1 foreclosure in a week. San Diego County had 3 foreclosures in a week. Can you imagine that? San Diego County having 3 whole foreclosures. It's a huge county in a week. You know why? Because everyone's got equity. And why would you get foreclosed? You just sell the house if you need to. So the idea that the wave of foreclosures is coming, that you see the crash bros and doomers talk about, it's not happening. We look at the numbers every month when they come out. There are no foreclosures. We're averaging about 15 a month in Vegas, about 1 every other day, right, with 400,000 houses just in this. We just tracked the city of Las Vegas.
So we've talked about this before. So why are there any foreclosures, right? And we've talked about this before. And when you see such a small number, you have to understand that most of this is actually somebody who's died. And I've said this before. It's somebody who's died, and either the heirs can't be located, or the heirs don't want to be bothered, or the heirs lack the financial know-how to navigate taking care of the property and making things work. That's really the bottom line. I mean, when you see someplace that has 3 foreclosures for the county, especially in a big populated area like San Diego or like Las Vegas or LA, I mean, you know that that's the case. You know that there's something more to it. It's not that somebody couldn't afford their payment, right? There's something else going on. And it's usually something like that.
The last one that I hear quite a bit is the boomers are going to die and those houses will flood the market.
2 things. 1, the boomers are in really good shape, okay? And 2, if COVID didn't kill them, this isn't going to kill them either, guys. So relax. If you really thought they were all going to die, you would invest in cemetery plots, right? So you could sell those off to them. And you're not doing that, are you? So clearly, none of us believe that the boomers are all going to die overnight.
Okay, so here's the thing. Let's say they do. Okay? It's not like the population is fixed, and as the boomers die, these houses come on the market with no one to buy them or live in them. Actually, here is the U.S. population and projection. This is from the U.S. Census Bureau, if you were wondering where it comes from. Now on this chart, we currently have about 330 million people in the U.S. It says by 2030, we're going to have 355. And by 2050, we're going to have 388.
Or if you look at the border, it could be sooner. But anyway.
Okay. But this shows the population just continuing to rise.
Yes.
Well, but why doesn't it show the dip where the boomers all die? Like, shouldn't the chart go up and then down and then up because the boomers all die?
So no, because we have more people coming to the country, more people being born and all of that. The other thing is, keep in mind that as the boomers are dying, the heirs are not selling. And that kind of like, I hinted at that a little while ago. the heirs are not selling. They're keeping them as investments, because remember, the heirs are older too. They're not, in their 20s. The grandchildren are maybe in their late 20s, but the heirs are in their 40s or 50s, and they don't need their parents' money as far as what's the equity that's in the house. They would just as soon keep them as rentals and take the income, because these people are at a place in their lives where the income is more valuable to them than a lump sum. So again, this is about estate planning, and I know that's not what this video is about, but I just need to point out that that's what's happening. These properties are not selling. I've had clients pass away and their heirs did not sell. They just kept them as rentals. In some cases, they've moved in and they've turned their home into a rental if their parents' house was nicer or in a better neighborhood. I've seen that a lot.
Yep.
I've seen that a lot, where they just go ahead and they refurbish the parents' house, they move into it, and they turn their own home into a rental. But the bottom line is that we're not seeing properties come on the market. And you know that because the inventory levels are so low. So what's your opinion? What's going on with the market where you are? Remember, real estate is hyper-local, so keep that in mind in your comments. Anything that you want to talk about real estate-wise, please feel free to put that in the comments. We welcome that. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.